Well, good afternoon. I'm Julie Williams. I'm the Acting Deputy Director for Supervision here at the Federal Reserve Board of Governors. And it's my pleasure to welcome all of you to the fourth EGRPRA public outreach event. Ongoing review and maintenance of our Federal Reserve Bank regulatory framework is important. It ensures the oversight of the financial system remains effective and efficient. And public commentary is an important part and component of that process. Policymakers will consider today's discussions in their decision-making as they review federal banking rules. So we look forward to hearing thoughtful feedback from our panelists. And before we get started, some logisticals. So today's events are being recorded. Only those that are registered to speak will be called upon today. For those participating virtually, you'll be called upon by the moderators. The AV team will give you rights to activate your camera and your microphone. Please be in a well-lit location if you can be, and please try to avoid background distractions such as loud noises. We have a full schedule of speakers today, so we ask that everyone adhere to the timing rules, and I'll do my best to keep us on track. And that I should mention, any inappropriate activity will be cut off by the AV team at their discretion. So with that, we'll get to the business and turn it over to our panel. Our panel is Enhancing Effectiveness of Supervision, and our panelists are Tabitha Edgens from the Policy Institute, Sean Campbell from the Financial Services Forum, Amy Ledgig from the Independent Community Bankers of America, and Stephanie Webster from the Institute of International Bankers. So welcome, everyone. And let's begin by having each of you give 5 minutes, and I'll do my best to keep time of comments, if that's okay. And can we start with you, Tabitha?
Sure.
Thank you.
Sure, thank you very much, Julie, and thank you to the Board of Governors for hosting today. We very much appreciate the opportunity to be here and to share our views. While the EGRPRA process generally we understand is focused on regulations, we very much support and appreciate the agencies taking the opportunity for a broader view and engaging in a review of the overall demands on financial institutions, regardless of whether those demands are imposed by regulation, guidance, or supervision. Hence our participation on this panel today focused on supervision. So we have been very encouraged, I think, overall to see a lot of action at the banking agencies already that have been intended to sort of refocus supervision on material financial risks and to enhance effectiveness and efficiency that way through the supervisory process. And I won't name everything because I know you all are familiar with that, but a few, the Fed's LFI rating system, the OCC and FDIC's unsafe or unsound, and MRA proposal that is outstanding, as well as the Fed's statement of supervisory operating principles, the pending proposals on reputation risk and supervisors' use of rep risk, and the review that has been sort of publicly announced of existing supervisory MRAs. So I think those are all very sensible reforms that are going to make supervision more effective, efficient, transparent, and consistent with the law as well. So with all that said, I think there are one thing that I think is important to appreciate stepping back are the real-world effects of a supervisory regime that is focused disproportionately on immaterial issues. It's hard to point to tangible data about those burdens and costs, given that so much of this is deemed by the banking agencies to constitute confidential supervisory information, which we will get to. However, there is sufficient information and data in the sort of public record that does show that the compliance demands aren't necessarily correlated with the real-world effects and financial safety and soundness. Again, I hesitate to repeat all of the data, which some of it has been, we know because it's been put out through information that the agencies have shared, but that includes data such as, as of the year end of 2024, 23 out of 36 LFIs were considered not well managed, despite the overall financial system being considered, stable and sound. And of course, that effect of being deemed not well managed has tangible effects on banks' ability to make investments, to serve their customers, to engage in transactions that grow the economy. Similarly, a November 2024 report by the GAO found that the majority of MRAs, matters requiring attention, issued by the banking agencies related to what are sort of can be characterized as non-financial risks. So those are MRAs that don't relate to capital, earnings, interest rate risk, et cetera, but rather on process, governance, and the like. So those are just sort of two manifestations, those data points on the overall supervisory demands and burdens that institutions face, which is to say nothing of sort of the day-to-day interactions with on-site exam teams, which include meetings, detailed information requests, and oftentimes overlapping communications with multiple agencies that have overlapping jurisdiction with respect to an institution. That's borne out by some data that BPI had found previously in 2024 that found that the management team at sort of the average BPI large bank spent upwards of over 40% of their time responding to compliance requests for information rather than sort of strategic business management unrelated to compliance actions. So with all of that in mind, I think a few key areas for improvement and modernization going forward. One is looking to the unsafe, or unsound, and MRA standards that, again, have been articulated by the agencies through pending proposals and the Statement of Supervisory Operating Principles. We support those actions and think that finalizing those through final rulemaking is helpful to provide the certainty and consistency that's needed overall to ensure that supervision is focused on material financial risks long term. Similarly, related to MRAs, a focus on, we support the use of non-binding supervisory observations, which are acknowledged in both the proposal as well as the supervisory operating principles. We encourage clarifying the role and the function of those supervisory operating principles through a final rule and through amending existing supervisory guidance, again, to clarify the role of those actions as non-binding, but nonetheless helpful feedback from institutions. I'm seeing my time is towards its end. Other MRA process reforms would be helpful on that note, including giving institutions an opportunity to engage with their on-site teams before an MRA is formally issued. Related reforms to the CAMELS ratings system, which of course is an interagency process, but is necessary to make the reforms in the safety and soundness and MRA rule fully effective, particularly the management rate component of the CAMELS framework. Maybe I will let the other panelists speak, and maybe we can turn also to CSI rules. I think there are some modernizing of the CSI rules that could also be helpful to promote just enhanced transparency of the supervisory process.
Excellent. Thank you, Tabitha. Sean.
Thanks. So thank you for the opportunity to contribute to today's panel. My name is Sean Campbell. I'm the Chief Economist at the Financial Services Forum. Our members, the 8 U.S. headquartered GSIBs, are responsible for over $5 trillion of loans to households and businesses and are essential to the success and resilience of our nation's economy. So robust supervision of our nation's banks is vitally important to the safety and soundness of the banking sector. Ensuring a safe and sound banking system requires that supervision be rooted in material financial risks that directly relate to a bank's financial condition. Supervision of a bank's risk management of its capital, liquidity, and asset quality serve as primary examples of areas in which meaningful oversight can serve to bolster the stability of a bank and the broader banking system. Supervisory activities that focus on issues unrelated to material financial risk weaken and dilute supervision by diverting scarce supervisory and bank resources from material matters that directly bear on safety and soundness. The specific experience of Silicon Valley Bank's collapse serves as an important cautionary tale. SVB was plagued by clear lapse in financial risk management that was known to supervisors for years. An assessment of the SVB debacle showed that the largest number of identified supervisory issues related to largely ancillary governance and controls issues rather than core capital or liquidity issues. These governance and controls findings included issues including third-party risk management, board effectiveness, and IT asset management. While hindsight is always 20/20, one can only wonder whether things would have turned out differently for SVB had supervisors focused more intently on core capital and liquidity risks. So how should supervisors go about refocusing their efforts to focus on bread and butter banking issues? In the spirit of today's meeting and the broader effort to refocus supervision, I'd like to offer a few constructive ideas on how to do that. To begin, supervisors need to clearly define what is, and importantly, what is not a material financial risk. Vague notions of materiality that rely on the you-know-it-when-you-see-it test creates costly uncertainty that only frustrates the supervisory process. Accordingly, the recent proposals by banking regulators to formally define unsafe and unsound practices is a welcome development that supports an effective supervisory process. We look forward to a clear and consistent definition of unsafe and unsound that is shared by all banking regulators to guide an effective and coordinated supervisory process. Supervisors should also reassess all existing supervisory findings, recommendations, and guidance to ensure that the supervisory process is not held back by past policies that are inconsistent with the focus on material risk. In this vein, we applaud the OCC's proposal to reconsider its heightened standards framework. The heightened standards framework is a good example of prior policy that erected an elaborate maze of process-oriented requirements that not only do not support true safety and soundness, but divert precious resources from dealing with core risk. As stated in our comment letter, we recommend repealing these bureaucratic and process-heavy standards in their entirety. The U.S. supervisory framework is complex. Multiple regulators have overlapping authorities over a single financial institution. Consequently, efficient, effective, and transparent coordination is required among all regulators to ensure an effective supervisory process. As discussed, a shared North Star clearly defining safety and soundness is a precondition to effective coordination, but it's not sufficient. Regulators should actively plan and coordinate their exam activities and findings to ensure that findings and interpretations are fully aligned and do not create inconsistent supervisory signals. In addition to tight coordination, consistency, efficiency, and transparency in the supervisory process is also necessary to support effective supervision. Going back to SVB, public reporting shows that many supervisory findings were open for multiple years before its collapse. Legitimate supervisory issues should be dealt with on a timely basis and should be subject to a clear, consistent, and objective process for closing supervisory findings. While supervisors have a legitimate stake in defining the required end goal associated with the supervisory finding, banks should have considerable discretion in how they deliver the results. Supervisors should remove any barriers to sharing information among a bank and its various federal and state supervisors to expedite issue remediation. Micromanaging how banks address supervisory issues only creates additional process that detracts from the goal of supporting a safe and sound banking system. Finally, it must be noted that regulators have already made considerable progress in refocusing supervision. As discussed, proposals on the definition of unsafe and sound practices, issuing pre-existing standards for public comment are steps in the right direction. Further, changes to the holding company rating system, as well as revised supervisory principles, all reflect important strides towards a more effective and efficient supervisory framework. We look forward to working with regulators to make further progress in this important area to support a healthy and safe banking system that works for everybody.
Excellent, thank you.
Great.
Amy?
Thanks so much. Good afternoon. I'm Amy Ledig. I'm VP in Safety and Soundness Regulatory Council, the Independent Community Bankers of America. As local and trusted sources of credit, America's community banks leverage their relationship-based business model and innovative offerings to channel the deposits they gather back into the neighborhoods that they serve, creating jobs, fostering economic prosperity, and fueling their customers' financial goals. I want to thank the agencies for their efforts to identify regulations that are outdated, unnecessary, or unduly burdensome, and to engage in this meaningful dialogue about how regulatory challenges facing community banks inhibit their growth and their ability to serve the Main Street economies that they power. We appreciate efforts to refocus supervisory processes to emphasize material financial risks over process-related concerns, as well as efforts by several agencies to overhaul their internal appeals processes in ways that enhance the independence and due process available in these procedures. In the time that we have today, I would like to discuss a key principle that regulators must keep in mind throughout this endeavor, which is the importance of tiered regulation and supervision, and then to touch on a specific improvement that community bankers urge the banking regulators and supervisors to undertake, which would be implementing a true short-form call report for community banks. So first, I'd like to discuss right-sizing supervision. A tiered approach to regulation and supervision appropriately tailors supervisory requirements based on a bank's size and risk profile, helping community banks operate safely and efficiently without unnecessary burdens. We encourage the regulatory agencies to continue to expand and refine a tiered regulatory and supervisory system that recognizes the significant differences between community banks and the larger, more complex institutions that make up the rest of the banking system in terms of the risks they pose to consumers and to the financial system as a whole. When the regulatory framework imposes outsized burdens on community banks, as currently exists in our system today, that diverts resources from their ability to support the financial needs of their customers, to serve their communities, and to contribute to their local economies without meaningfully improving the safety and soundness of the banking system. One aspect of this would be modernizing and indexing regulatory thresholds, which I think will be discussed later today as well, but wanted to touch on that. Community bankers and the ICBA continue to advocate for regulators to modernize static, outdated thresholds that over time have subjected increasing numbers of community banks to regulatory requirements that were intended to apply only to the largest banks. Raising and indexing overly restrictive thresholds gives institutions more room to grow, reduces unnecessary compliance costs, and strengthens community banks' ability to attract and build capital. Efforts to appropriately tailor supervisory expectations and requirements, as well as ensuring that thresholds are regularly adjusted and remain relevant to the evolving banking landscape and where the risks actually lie in the banking system, can ensure that community banks remain a thriving part of the landscape, providing credit to Main Street economies and powering America's small businesses, agriculture, and rural communities. As a practical, straightforward suggestion, I would like to discuss streamlining the call report as my next point. Efforts in revising the call report requirements in recent years have not fully delivered on Congress's intent to right-size the burden on community banks for reporting. We recommend implementing a true short-form call report for the nation's community banks. Doing so would be a meaningful way to better calibrate the compliance burden imposed on community banks without substantially increasing systemic risk. As part of this proposal, we would encourage the banking agencies and supervisors to, in the first and third quarters, have community banks be permitted to report a balance sheet, an income statement, and statement of changes in shareholder equity in a concise set of limited schedules. A full call report would still be required to be filed mid-year and at year-end. This approach to reporting would materially reduce burden on community banks that are small, straightforward lenders that rely on tailored underwriting and a local presence to provide quality banking services. This is a practical suggestion that would be easily implemented and would result in meaningful reduction in the compliance burden without a significant increase in systemic risk to the financial system. ICBA and the nation's community bankers applaud the current efforts of the banking agencies to reduce the burden of regulation on community banks. Community banks stimulate growth in every corner of the country. We appreciate the efforts that have already been made in terms of improvements, some of which my fellow panelists have discussed, but also like to acknowledge raising and indexing the fiducia thresholds, which are the annual reporting, audit and reporting requirements in 12 CFR Part 363, as well as improvements to the calibration of the community bank leverage ratio and other proposals that appropriately tailor supervisory requirements and approaches for community banks. And we hope that this EGRPRA process will serve as a further catalyst for additional reductions in unnecessary regulatory burdens on community banks. Thank you for your time.
Thank you. Stephanie?
Thank you. I'm Stephanie Webster, General Counsel of the Institute of International Bankers. Thank you for the opportunity to speak today. The Institute of International Bankers represents internationally headquartered financial institutions from more than 35 countries that do business in the United States. Our members operate through U.S. branches and agencies, bank subsidiaries, and broker-dealer subsidiaries. Many also maintain intermediate holding companies that are evaluated under the Federal Reserve's Large Financial Institutions, or LFI, rating framework. For that reason, the IIB supported the Federal Reserve's recent revisions to the LFI rating system. Those changes meaningfully improved transparency and predictability and critically mitigated the disproportionate effect that a single deficient one component rating, typically in governance and controls, can have on an institution's well-managed status. Today, I'm here to focus on what should be the next step, the need for comparable reforms to the ROCA and CUSO rating systems, which apply to the U.S. branches and U.S. operations of internationally headquartered financial institutions, or known in the regulatory framework as FBOs. These reforms are necessary to align with the administration's and Vice Chair Bowman's policy objectives of focusing more on material financial risks and creating transparent and predictable supervisory outcomes, as well as ensuring national treatment and competitive equality for FBOs. As currently applied, ROCA and CUSO downgrades have consequences for FBOs that are just as severe and in some cases more mechanical than downgrades under the former LFI framework. FBOs with U.S. branches receive ROCA ratings covering risk management, operational controls, compliance, and asset quality, both at the branch level and for multi-branch FBOs on an aggregated basis. Multi-office FBOs also receive a CUSO rating, which covers U.S. branches and U.S. non-bank subsidiaries in a single composite score. These ratings are distinct from an LFI rating for an IHC subsidiary or an RFI rating for those subsidiaries that qualify as a bank holding company, and the CAMELS ratings if the FBO has a subsidiary depository institution. Federal Reserve staff has taken the position that an FBO's well-managed status and therefore its eligibility to operate as a financial holding company depends on both a combined ROCA rating of 2 or better and a CUSO rating of 2 or better. As a result, ROCA and CUSO ratings play a decisive role in whether an FBO may engage in acquisitions and non-banking activities, even though these rating systems focus overwhelmingly on non-financial risk. The core issue is this: ROCA and CUSO ratings do not appropriately balance risk management issues against financial condition and those material financial risks. ROCA ratings, except for the asset quality component, are heavily focused on policies, procedures, and governance infrastructure. In practice, a single compliance or control issue can drive ROCA components across multiple ROCA components. In other words, double or triple counting a single compliance deficiency. For example, if you had a compliance deficiency in your AML program, that could impact the risk management, it could impact operational controls and compliance components simultaneously, frequently leading to a composite downgrade. CUSO ratings similarly raise concerns and in some ways raise greater concerns. They are issued as a single composite score based on broad and highly generalized standards that aggregate ROCA, CAMELS, and LFI or RFI assessments. Federal Reserve guidance explicitly states that a CUSO rating of 3 may be assigned if any one of risk management, operational controls, or compliance is viewed as unsatisfactory. The result is reduced transparency, reduced predictability, and heightened risk that a single non-financial issue, however limited in scope, determines well-managed status. In light of the Federal Reserve's policy vision in revising the LFI framework, we urge comparable reforms to ROCA and CUSO. Specifically, the Federal Reserve should revise supervisory guidance and the statement of supervisory operating principles to, among other things, remove the notion that a single deficiency in risk management, operational controls, or compliance can automatically render an FBO not well managed. Increased transparency around how CUSO ratings are derived from underlying ratings, which currently operate with different methodologies, and there is an unclear weighting of each of those different components. Incorporate liquidity as an explicit component of FBO ratings, reflecting its central role in supervisory policy, particularly since March of 2023. And undertake a broader reassessment of the FBO ratings framework to simplify it, to improve consistency, and to achieve a more balanced emphasis on financial condition and safety and soundness. I want to underscore the main point I want to underscore here is the need for clarity and transparency. Since the enactment of Section 606 of the Dodd-Frank Act, the standard for determining whether an FBO is well managed has been opaque. Regulation Y still refers only to a ROCA rating, while staff practice reflects reliance on both ROCA and CUSO ratings without clear articulation in regulation or supervisory guidance. Given the significant consequences of losing well-managed status, the Federal Reserve should formally articulate its standard either through regulation or supervisory guidance. Aligning ROCA and CUSO with the revised LFI framework is not only sound supervisory policy, it's necessary to preserve national treatment and competitive equality for internationally headquartered financial institutions operating in the United States.
Stephanie, I think you're at time. Do you want to wrap up quickly? Or?
We appreciate the Federal Reserve's willingness to modernize its framework and look forward to continued engagement.
Thank you. So we have a little bit more time. Tabitha, you mentioned CSI. Is there anything more you want to elaborate on that? I wasn't sure if you
Sure.
were making a point.
Yeah, I'm happy to, because I think this is an area where there are some updates that is fairly targeted actions that could be helpful in making the CSI regime more workable in practice. Just to cover the basics, I mean, there's a good reason, of course, for much of supervisory information to remain confidential, given that that confidentiality is rooted in what is ultimately a safety and soundness consideration to protect bank information. But the CSI rules as they're currently drafted, and they are different among the three agencies, are somewhat overbroad and impractical, as well as outdated. And because of that overbreadth, it chills banks' ability to both utilize and share important commercial and regulatory information with other parties that have a legitimate business, legal, or governmental interest in the information. So I think we would say that there are three types of reforms that would be helpful to the CSI framework. One is updating the agency's articulation of criminal penalties for CSI violations. This is based on an agency view that CSI is government property and that disclosing it as criminal theft of government property, that threat chills what is oftentimes legitimate information sharing, and it's also been rendered, again, outdated in light of some intervening case law that really casts doubt on sort of a governmental theft theory. Rather, I think casting CSI in terms of safety and soundness would be a more appropriate way to articulate the restrictions. Second, authorizing limited disclosure among banks and government agencies to share information within the CSI framework would be helpful. Vice Chair Bowman has talked about that in the context of cyber and fraud information sharing, where there's good reasons bank may need to discuss the information that, my examiner told me this, my examiner told me that. We see this also in the context of sort of horizontal examinations, where institutions hear things from their examination teams, but given the overbreadth and, again, the threat of really tough sanctions, it chills the ability to even talk secondhand about some of the information that is shared. Finally, the agencies could revise the rules to adopt a uniform framework across the three banking agencies that will improve the day-to-day workability of the existing rules, that will allow more information sharing on a voluntary basis without agency approval, but subject to binding confidentiality agreements. And that can help with addressing the underlying policy concerns that motivate the CSI framework, again, rooted in safety and soundness. So that's things like sharing with the bank's own auditors, their outside counsel, their affiliates, potential counterparties to mergers and acquisitions, candidates for senior management and directors roles. Right now, all of that is subject to the need to get approval to share information, whereas you could just change it to where you can share subject to a confidentiality agreement.
Thanks. Do any of the other panelists want to comment on the CSI topic?
I would just, I support what Tabitha has said, and I would just add another example is a lot of our members have difficulty sharing confidential supervisory information with their home country regulators. The process for getting permission is very opaque, and it takes a long time, and so having reforms that would allow them to share information with an actual reasonable request would be helpful.
So I would identify with all the great points that Tabitha made. The one thing that she said, which she said very quickly, but really struck a nerve with me, is that we have multiple regulations defining CSI that are different. So just soak that in for a minute. So if you're a large financial institution, you have a holding company and you have a bank, then you have to comply with multiple regulations over what even the definition of CSI is. And you can imagine the analysis that a bank would have to do to even determine if a piece of information was CSI under both rules or one rule. It seems like a prime example of the kind of thing that is an unnecessary use of sort of process-related time and energy that could be better spent elsewhere.
So is there anything that we haven't talked about that you think could be impactful in reducing burden? I know you've pointed out all of probably the most primary things that you think are appropriate, but wanted to give you the opportunity if there's some secondary things that we should be thinking about.
I ran out of time, so I'll make one more. Note. I think several of us have touched on the CAMELS ratings framework for for IDIs, which is an important step to actually effectuate many of these other changes that we're talking about. So the unsafe and unsound and the MRA reforms ultimately won't be fully effective unless you can also address the effect of the ratings framework, and specifically the the management rating, which is the most subjective, I would say, in our members' experience, because it's the only among the components in CAMELS, it's the only one that's not tethered to a sort of a measurable financial metric like capital, asset quality, et cetera. So the management rating isn't required by statute, and moreover, management is encompassed within the other components of CAMELS. It reflects management of capital, management of liquidity, et cetera. So I think in light of all of that, well, I should also say it also is the most consequential. Despite being the most subjective, it's also the most consequential of the components, because a downgrade to 3 on your management framework is enough to disqualify an institution from being considered well managed, which then has legal restrictions on the bank's ability to conduct activities. So I think really taking a hard look at that management rating, either eliminating it altogether and and reliance on those other financial components, or reframing it to look at material operational risks, to really sort of drill down on the more financial risks inherent in that component would be helpful.
Can I jump in on that quickly? I think that's an interesting point. One thing I would caution would be to maintain some flexibility. I think community bankers are not in favor of eliminating management from CAMELS, and I would encourage some, room for each institution is different. And again, as discussed in regulation earlier, community banks operate differently than the GSIBs and should have, different levels of evaluation for the effectiveness of management. I would urge the agencies not to overemphasize form over substance here. If it turns into a rubric that's based on formalized structures and formalized governance, that I think would be form over substance and would not reflect, particularly for community banks, the deep knowledge that community bankers have of not only their institution but their business line, the communities they operate in, and how to best manage the risks there. So just would urge that to remain top of mind.
Is there anything, specific that you would recommend on the supervisory process itself? So we've talked quite a bit around different rules, different assessments and things like that. Are there any process-oriented recommendations that you might put forward?
So one that comes to mind is, I think it was mentioned maybe by Tabitha very, very briefly, or somebody, is the use of basically horizontal reviews in the supervisory process. And it's natural to want to make comparisons in all walks of life. It's a very natural way for performing analysis of a whole variety of things. But a horizontal review process in the context of the supervisory process, it really needs extremely careful consideration for a variety of reasons. And the first of which being, you really need to be careful that you're basically comparing likes with like. And it is oftentimes the case that two institutions that in some broad sense are similarly situated in the context of a particular business line or the context of a particular practice, owing to just differences in their business footprint or their risk profile or what have you, just aren't the same and can't be meaningfully compared. And I think some of the broad feedback we get from our memberships around the horizontal review process is that oftentimes it can drive supervisory decision making and approaches to supervision and that are not really well rooted substantively because they start off on the wrong foot, i.e. they're basically comparing apples and oranges and trying to make an apple look like an orange, and that's a problem from the outset. And more broadly, with respect to the supervisory horizontal review process, we have a supervision process, which was, as I mentioned, and I think everybody agrees is vitally important when appropriately conducted to ensure safety and soundness. Then we have a policy process. And the policy process has along with it, for lots of good reasons, a lot of transparency requirements, public reporting, notice and comment. There's a really rigorous governance process around the policy process that's there for lots of good reasons. And at times, it may be the case that the horizontal review process kind of bleeds in to a policy process, but does not come with all the governance processes that come with the standard policy process. So for that reason, in addition, we think that a really hard look needs to be taken at looking at the horizontal review process and its use in the supervisory process.
Thank you. Does anyone else have any comments on that?
Thanks. I think community bankers and I would urge additional transparency and consistency. I think we've seen improvements in those areas in the supervisory process over the last year and a half. But I think one aspect of that would be helpful would be limiting unnecessary duplicative information requests. Sometimes requests for information during examinations or reviews of applications are over-inclusive and sometimes repetitive, where the agency might already have the information elsewhere. Or have already reviewed it and requesting again, and that ties up community bank leadership and management resources that could be better put towards expanding access to banking products and services on Main Street America. So thank you.
I would just, I would echo Sean's comments on horizontal reviews for our members. Their structures in the United States are very different than some of their domestic counterparts, and again, it's you're not really comparing like to like in those situations. I would also agree with Amy's comment on unnecessary burdens and unnecessary information gathering. We've heard from our members, particularly in the area of regulatory reporting. They'll make reports and they'll get the same questions over and over again. The call report you mentioned is one area, but we've heard that regularly, that it appears that sometimes it's not clear why that data is being asked for or if it's even being used, and the questions that they're getting back, it seems clear that people are not necessarily being as thoughtful about why they don't, the supervisors don't even necessarily know why they're asking for that data.
So is there anything, maybe you've already covered it, but if not, another chance at it, anything specific to each of your memberships that might be uniquely burdensome for your members in particular?
So I'm not sure how unique of an issue this is for our membership, but something that I think I do hear about that would be helpful, that's just another process-related improvement that I don't think we've really covered in depth is, we've talked about sort of the standard for MRAs and how the agencies have defined, whether through proposed rule or through the supervisory operating principles, what the right standard of material, risk of harm to the institution is. One thing that I think would be helpful as that is being implemented is that these standards also reflect a requirement for that to be supported with evidence to the institution, and to sort of just and it's no quantitative test or anything like that, but just to show the work of how we reach the conclusion that this particular practice presents a threat to the to the safety and soundness of the institution, just outlining with numbers and information, and again, evidence for why the supervisor is drawing that conclusion. And I think by supporting with evidence, I think that helps in a couple of ways. One, it helps to avoid some of the trickiness with, like, is it likely, or is it, a serious threat, or all of it. If you have something showing why it's likely, it can help make that conversation more productive. And related, I think that's an opportunity to sort of clear up any misunderstandings, or to surface any sort of factual discrepancies between the institution and the supervisors if they're working from a common set of facts. So I think that would be helpful to just, again, sort of clarify as we're thinking about what the substantive standard is, to also clarify how it should be evidenced.
Great, thank you. One thing that I hear from talking to community bankers across the country is that sometimes supervisory expectations that are appropriate to the largest banks, even if they aren't on paper applicable to community banks, those expectations can have a trickle-down effect and become relevant to discussions with their examiners, with their supervisors. And we appreciate remarks from the heads of the agencies recently about appropriately insulating community banks from expectations that are not appropriate for their size, their complexity, and their asset level. I would also note that part of tiered regulation is that, in our opinion, the nation's community banks, which are smaller, have a more straightforward business model, and are not individually a risk to the financial system, should be subjected to less rigor or less onerous of a regulatory burden. On the flip side, we think it's very important to maintain adequate safeguards on the largest too-big-to-fail institutions and ensure that they are supervised commensurate to the risks that they pose to the banking system. Appropriate deregulation and streamlined supervisory requirements where applicable. We think that's good for everyone, but we do need to ensure that safeguards are left in place so that community banks and their customers don't pay the price for not having the implicit guarantee that some of the largest banks benefit from.
I guess just one thing I would point to briefly, which is relevant for our members, which are very large, very well diversified global companies, is this issue of material financial risk. So all three parts of that statement are important, and so let me focus on the materiality issue. So, if you're thinking about a large bank holding company like the ones that we represent at the forum, if you pick a particular risk at random, then probably it exists somewhere inside one of the firms that we represent to some degree, but that does not mean it's material. And so, in conducting supervision and really trying to ensure safety and soundness, what we're really trying to understand is whether or not there's a risk out there that presents, again, a material risk to the safety, soundness, solvency of the firm. And so just because that quantum of risk can be said to exist somewhere inside the firm in some state of the world, that doesn't necessarily imply that it's material. So really, and this goes to the data and evidence component, which is to say, if you're supervising for a particular risk, or if you're raising a particular risk, some thought really have to go into quantitatively trying to size the problem before we get started down the road of really trying to sort of kind of untie that Gordian knot, because it can be the case that it's just not material for the firm in question.
And I would say, while I don't want this to be a woe is me moment, a lot of times our members tend to be an afterthought, whether it's in supervision or regulation. The example I gave of the CUSO ratings, while there was a reference in the economic analysis section of the LFI proposal to the well-managed status of FBOs, which reflects, again, a previously unpublished staff view, the most that we have now is a reference in a rule that doesn't necessarily apply to those standards. I'll give you another example. The Federal Reserve's guidance regarding flexibility to design a U.S. risk committee for purposes of Reg YY. In response to comments by the IIB, the Federal Reserve helpfully clarified a number of points, including flexibility for FBOs with a sort of a two-tiered board structure. But they published this guidance in the preamble to a reporting form, which effectively made this helpful guidance effectively be lost and very difficult to point to. So given the fact that foreign banks contribute trillions of dollars into the U.S. economy, we'd like to see them a little more front and center.
Maybe just to put a little bit, really interested in the materiality comments and would be interested to hear from all of you. Is there a particular measurement that you would anchor around in the materiality space? Do you have thoughts around how that could be better defined?
So I'll start. I mean, I think it's a little bit hard to have a one-size-fits-all metric there. As I'm an economist by nature, so I would love to have one of those. But I think the reality simply demands that that's not likely the case. But however, that doesn't mean that in the context of the particular facts and circumstances that you can't have a thoughtful approach to trying to quantify, what that is in a way that is transparent and that is made clear to the firm. And that the firm has an opportunity to weigh in on. So I very much identify with it would be wonderful to have the grand unified field theory of materiality, but that probably won't obtain in any world that we live in anytime soon. But that doesn't mean that you still can't have a rigorous approach to defining it, I guess. Yeah.
And I concur with that. I think as we think about this, it's hard, to Sean's point, to set a numerical threshold and realize to every rule there will be exceptions, et cetera. So to my mind, the best way to deal with that is this issue of how do you make the case, and that's providing the evidence, providing the demonstrable analysis for why this particular practice could, under reasonably foreseeable circumstances, present a threat to the condition of the firm, and that's the most predictable and applicable way to administer the standard.
Yeah, I think to some degree, this is one of the things where you know it when you see it, and I think it is maybe a more qualitative analysis as opposed to a quantitative one. Different, risks show up in different manners, and I think one thing that community banks are concerned about is tying regulators' hands to identify emerging risks at the largest institutions that pose the greatest systemic risk, and we want to ensure that regulators are able to identify and address those before they truly do become a, crisis type situation. Thanks.
I would just echo Tabitha and Sean's comments that I think, unique structures of our members, even amongst the U.S. banks, it lends itself to more of a justification and an analysis on an institution by institution in an institution-by-institution setting.
Do you think this bar or the measurement we might point to should be different? You talked about in a large firm, it's fast, there's lots of opportunities. Then there's a CBO side of that. Any thoughts on those differences?
I think a strict asset threshold would not be appropriate. Something that is something would have to be a truly astronomical level of dollar value to be material to the GSIBs, and so I think setting a strict quantitative threshold like that could allow legitimate material risks to go unnoticed.
I think on that point, just the proposals that we've seen kind of have it about right in terms of still equipping the supervisors to be able to intervene in, when there are sort of risks or potential risks they see emerging. So you kind of think through the waterfall that is provided for in what we've seen, and that's, the ability to issue supervisory observations if there are potential risks that are noted by a supervisor, but they're not able to provide demonstrable analysis for why they think that could become a threat to the institution. And then the next question is there a foreseeable state of the world where this practice could present a threat to the institution, in which case it does meet the standard for the MRA, which is still sort of slightly removed from then the safety and the actual unsafe and unsound standard in the statute. So I think as you think through the cascade of options, it does sort of adequately address that that need to be able to intervene appropriately early.
So we have just a few minutes left. Any other issues, topics that you would like to bring up, or last comments that anyone would like to make?
I would just reiterate that, our members are very supportive of the work that's being done, and we hope that that work continues. There's this kind of outreach and other discussions, I think, are very productive, and so thank you for taking the time to do it.
I would echo that. Let's end on a good note here. Thank you to the agencies and their staff. We know how much time and effort goes into this, and we appreciate taking a hard look at where there is room for improvement, and we hope that this is a catalyst for additional appropriate deregulatory efforts. Thank you.
Likewise, so thank you.
Thank you.
Thank you for being on our panel. Appreciate it.